You have two choices when entering an option contract. You can buy it, that's called going long, or you can sell it, that's called shorting. You choose to buy or sell based on your sentiment about the stock. There are benefits and downsides to both positions, so you'll need to fully understand the distinction to generate consistent returns investing in options. We'll start with buying and selling calls, specifically the way rights, strike price, and expiration impact the process. In our call option example, Arnold was the buyer. He saw the potential value in B's record collection, so he paid a $100 premium for the right to buy the albums for a $10 strike price with an expiration date 5 years in the future. During that time, Arnold sought buyers who would pay him more than his $11 break-even price before the expiration date arrived. B is the seller. She takes Arnold's $100 premium because she thinks the records are worth less than $10 each. By accepting that premium, she is obligated to sell the collection to him for $10 an album over the next 5 years. Once more, as with every option contract, there's a buyer, a seller, a premium, a strike price, and an expiration date. When expiration day arrives, one of two scenarios will play out. In the first scenario, it turns out each record is worth $20. That's $9 more than Arnold's break-even point. He exercises his right to buy the albums from B for $1,000. This makes Arnold the proud owner of a record collection worth $2,000. When Arnold factors in his initial investment of $1,100, he walks away with a $900 profit. Meanwhile, not only does B get rid of the record she didn't want, she earns $1,100 along the way. On to the second scenario. When expiration day arrives, the records are only worth $1 apiece. Arnold has no reason to exercise his right to buy B's collection for $1,000 because he can get those same records elsewhere for $100. And since he's the buyer of the call, it's up to him to decide whether or not to exercise the rights afforded to him by the contract. As the seller, B keeps Arnold's premium along with her record collection, and Arnold accepts his maximum loss of $100. Now let's translate this scenario to Wall Street. You're bullish on a $50 stock, so you buy or go long on a call contract with a strike price of $55 for a $25 premium that expires in a month. As the buyer, that $25 represents your maximum loss on the contract because you own the rights to exercise the deal or not. The break-even on your long position is $55.25. That means your contract becomes profitable as soon as its value rises above $55.25. Having accepted the terms of the contract, the seller sells or shorts the position and collects the $25 premium from you, which represents their maximum profit. The seller's break-even point is the same as yours, $55.25. The difference is that their short position only remains profitable as long as the stock stays below $55.25. As with any option on expiration day, one of two things can happen. Scenario 1, the stock is trading at $60 per share, well above your $55.25 break-even point. You go to the seller and purchase stock that's worth $60 for only $55. To calculate your profit, subtract your break-even point from the individual share's value at expiration. And there you are, $4.75 per share, or $475 total profit. A $475 profit equals a 1,900% return on investment with an initial stake of just $25. However, that $475 has to come from somewhere. When the seller collected the $25 premium, they assumed the risk if that stock should rise above the $55 strike price. Since the stock is trading at $60 on expiration day, the seller is responsible for paying out the difference to you, the buyer. They might have collected $25 at the beginning of the contract, but they end up paying out nearly $450. That was the best case scenario for the call option buyer, but let's see how the contract plays out in scenario 2. You paid a $25 premium for the right to purchase a stock for $55 a share 3 months out, but on expiration day, the stock is only worth $54. There's no reason for you, as the buyer, to exercise your right to buy when you can get those same stocks for less money elsewhere. You've lost your initial $25 premium, thus realizing your maximum loss. The seller, meanwhile, gets to pocket the $25, having assumed correctly that the stock's value would stay below their $55.25 break-even point. To recap, in a call, the buyer assumes a defined maximum loss, the premium they pay the seller, and an undefined upside, whatever the stock is worth at expiration. The seller in a call option contract assumes a defined maximum profit, the premium they collected from the buyer, and an undefined downside, whatever the stock is worth at expiration. Those are the basics of buying and selling a call option contract. Now it's on to the puts.